Welcome to a deep dive into a book that, well, really shook things up in investing 50 years back, and honestly still does today. Burton Malkiel's A Random Walk Down Wall Street. We're digging into the source material you shared those excerpts from book Malkiel's Random Walk Deconstructed. Our mission, to really unpack this huge text, we want to pull out the key insights, understand the main message, see how it stacks up now, and find that single, most powerful idea you can actually use.
Yeah, and at its core, it's a pretty challenging idea he puts forward. Basically, that a lot of what we think about picking stocks, beating the market, Malkiel argues it's just way, way harder than most people realize. Maybe even a myth for the average person.
That's a huge claim, right? Especially back then. To get why it was so, controversial, we kind of need to picture the investment world he was pushing back against in 73. What was going on?
Oh, it was definitely an era of intense faith in growth stocks, particularly this group called the Nifty 50.
Ah, yes, the Nifty 50.
Right, about 50 big companies, names everyone knew, IBM, Xerox, Polaroid, McDonald's, that sort of thing. The idea was they were one-decision stocks. You just bought them. Didn't matter the price, just hold them forever.
And looking back, those prices, wow. The sources mentioned valuations, like 50, 60 times earnings, sometimes higher.
Exactly. It was pure growth at any price. A sort of hubris, really, that normal valuation rules just didn't apply to these darlings.
Okay, so that's one part. What else?
Well, alongside that, there was just massive faith in, expert analysis, technical analysis, looking at charts for patterns.
Certainly, yeah.
It was super popular. And fundamental analysis, digging into the company's financials, management, all that, that was seen as the definite way to find undervalued gems. Star fund managers were basically legends. The belief that experts could consistently pick winners was just everywhere.
So Malkiel steps into this scene and sees just noise, an illusion.
Pretty much. An illusion of control. He saw investors trying to time the market or pick stocks like lottery players, thinking their lucky numbers actually give them an edge. He thought they were often seeing patterns, signals, in what was really just, random movement.
And the timing of the book, 1973, that's really interesting. It didn't just appear in a calm market, did it?
No, not at all. It landed right in the middle of a, frankly, brutal bear market that ran into 74. And it wasn't just some minor dip.
What was driving it?
Well, you had the OPEC oil embargo, massive inflation, stagflation they called it, plus Nixon taking the U.S. off the gold standard. I mean, it was a really scary economic time.
Scary is right. The S&P 500 lost almost half its value, peak to trough.
Yeah, something like 48%. And that kind of pain, that kind of upheaval, it makes people question everything, right? Suddenly, those Nifty 50, the untouchables, they got absolutely hammered. It was a very real, very painful lesson about ignoring valuation.
So people were suddenly much more open to hearing Malkiel's contrarian ideas.
Exactly. His message landed on fertile ground.
And the book's longevity, all those updated editions over 50 years, that tells you something too, doesn't it?
Definitely. The issues he pointed out, bubbles, chasing forecasts, emotional investing, they aren't just 70s problems. They keep happening. It's human nature in market.
Which brings us to his big solution. If the old ways are flawed, what's the answer?
Well, his core thesis, it's built on this really powerful idea. Financial markets are incredibly efficient.
Efficient,
meaning prices adjust very, very quickly to reflect all the information that's out there.
Okay.
And if that's true, the direct consequence is that short-term price moves are largely unpredictable. Random, essentially. That's the random walk.
Right. So the big insight for you, the listener, is if prices already reflect what's known, trying to consistently beat the average by picking stocks or timing the market, it's incredibly hard. Even for the pros, the edge is just tiny, if it even exists consistently.
Exactly. So given that, Malkiel's practical advice becomes, pretty straightforward for most people. Don't try to beat the market. Just buy the market. Buy and hold a broad, diversified, low-cost index fund.
Okay, so that's where he lands. But every big theory has assumptions underneath it, right? Foundational beliefs. What does Malkiel's idea rely on?
Yeah, good point. One absolutely critical assumption is rapid information incorporation. The whole efficient market hypothesis, the engine of his theory, depends on new info getting baked into prices almost instantly.
Like that die-in-the-pond analogy you mentioned. It spreads everywhere immediately. You can't scoop up clear water once the die hits.
Precisely. And arguably, this is even more true today. High-speed trading, instant global news. The window to act on public info before it's priced in, it shrunk dramatically. This really backs up this semi-strong form of market efficiency, which is kind of Malkiel's home turf.
Got it. Info gets priced in super fast.
Yeah.
But what about people? We're not always rational, right? Malkiel talks about biases. If markets aren't perfectly rational, why is beating them still so hard?
Right, and that leads to the second key assumption. It's not that markets are perfectly rational, but rather the profound difficulty of consistently exploiting irrationality. Meaning, Malkiel acknowledges biases exist, herd behavior, overconfidence, fear, greed. These do cause mispricing sometimes. Prices do deviate from, perfect value.
Okay, so opportunities pop up. Why can't smart investors just grab them?
Well, Malkiel's practical answer, reading between the lines of his advice, is that even though these moments happen, for the average person, and honestly, even for most professionals, consistently identifying them before everyone else, and then profiting after costs, risks, taxes, it's just incredibly difficult. You need the skill, the resources, the nerve, and you need to be right often enough.
It's easy to see a bubble afterwards, much harder to time it perfectly.
Exactly that. So the assumption isn't zero irrationality, it's that reliably arbitraging that irrationality is beyond most people's reach most of the time.
Okay, that makes sense. So markets are efficient, short-term moves are random-ish, exploiting irrationality is tough. Given that reality, what's the operating system Malkiel suggests for an investor? How do you actually navigate this world?
It all starts with that foundation. The efficient market hypothesis, EMH, and the random walk. EMH means prices reflect info, the takeaway for you.
Yeah.
You can't reliably get above average returns using info everyone else already has. It's in the price.
And you mentioned the different forms, weak, semi-strong, strong. Malkiel mostly focuses on semi-strong, right? Challenging fundamental analysis based on public info.
That's his main camp, yeah. Weak form knocks out technical analysis based on past prices. Strong form, that all info, including private, is priced in. He's a bit more cautious about claiming that, absolutely.
And the random walk is the metaphor for how prices move short-term.
Exactly, like a coin flip or a drunkard's path. The last step doesn't predict the next one. Doesn't mean there's no long-term upward trend from economic growth, just that the next step is unpredictable based on the last step.
Okay, if moves are random and info is priced in, then the usual tools people use, they need a rethink. Which brings us to pillar 2, deconstructing alpha generation. How do you actually try to beat the market, and why doesn't it usually work?
Right, this is where he really dismantles the common ways people try to get alpha or outperformance. First target, technical analysis. Charting.
Head and shoulders, support and resistance, all that stuff.
Yeah. The belief you can predict the future from past shapes on a graph. Malkiel, based on weak form efficiency, basically says these are illusions. Patterns you'd find in any random data set like stock market astrology.
And he felt it needed debunking.
Oh, definitely. Because it looks kind of scientific, right? It lures people into trading a lot, racking up costs and taxes, chasing ghosts in the charts. Often for subpar results, there are real costs involved.
Okay, so charting is out. What about fundamental analysis? Digging into the company, its value.
He's not saying understanding a business is bad. Of course not. But he argues that reliably using that understanding to find stocks so undervalued that you consistently beat the market. That's the incredibly hard part.
Why so hard?
Well, again, semi-strong EMH suggests most public info is already reflected in the price. Plus, think about it. Forecasting earnings, growth rates, discount rates, years into the future. It's massively uncertain, full of potential errors. And even if you are right and you find a gem, there's no guarantee the market will ever recognize it or do so quickly enough for you to profit significantly.
Right. This really pushed back on that idea that just doing your homework guarantees you'll get rich in the market.
Yeah.
It challenges the whole stock picker hero narrative.
Absolutely. So if chasing alpha with charts or deep fundamental dives is so unlikely to work consistently for most people, what do? That leads directly to his main prescription. Passive investing via index funds.
The logic is simple. Can't reliably beat the market, own the market.
Exactly. Get a piece of everything through a broad, diversified, low-cost index fund and just hold on for the long term.
And the index fund itself was kind of a radical idea back then.
Oh, yeah, totally. The industry was dominated by active managers charging high fees, promising they could beat the market. Index funds were simple, transparent, cheap. They offered a way to capture the market's return, the beta, instead of paying a lot to chase elusive alpha.
So Malkiel really provided the intellectual firepower and the practical tool for everyday investors to say, you know what, maybe I don't need that expensive manager.
Definitely. The massive growth in passive investing we see today, a huge part of that is his legacy.
Okay, so that's the intellectual side. Market efficiency, index funds.
Right.
But investing triggers emotions, right? Fear, greed. How does Melchior's framework help with that? Pillar 3, psychological armor.
Yeah, this is crucial. He knew successful investing isn't just about brains, it's hugely about temperament, discipline, patience, humility, and really internalizing the efficient market random walk idea helps you build that. If you accept that short-term bumps are mostly unpredictable noise, not signals you missed.
You're less likely to freak out and sell at the bottom.
Exactly. Or get swept up in the next bubble thinking this time it's different.
He talked about specific traps, right?
Yeah.
Biases.
Overconfidence thinking you or some guru knows better. Herd mentality, that powerful urge to just follow the crowd, up or down. Loss aversion. You know, how losing $100 hurts way more than gaining $100 feels good.
Yeah, that one's tough. Makes people hold losers too long.
Right? About 2.5 times more painful, research suggests. And site bias, looking back after something happened and thinking, oh, that was obvious, which just fuels overconfidence next time.
Recognizing those biases is the first step, I guess.
Absolutely. Just knowing they exist helps you guard against them. And this is where Malkiel's whole philosophy provides real psychological comfort, not just financial strategy. It cuts down on stress. If the market tanks and you believe short-term moves are random, it's not your fault for picking the wrong stock. It's just volatility. It depersonalizes it. Helps you sleep at night, helps you stick to the plan.
And the index fund strategy itself is kind of built-in psychological armor.
In a way, yeah. It's a set it and mostly forget it plan. Fewer decisions mean fewer chances for emotion to screw things up. And things like dollar cost averaging, investing the same amount regularly and force discipline automatically, takes timing out of the equation.
Okay, so that's the framework you built back in the 70s. Impressive.
Yeah.
But markets change, right?
Right.
How does it hold up today? 50 years on. We need to stress test this.
For sure. Let's start with the timelessness test. What's the biggest sign his ideas are still relevant?
Well, I guess a massive shift towards passive investing has to be Exhibit A, right?
Absolutely. Trillions have poured into index funds and ETFs globally. You mentioned the stat by 2024, passive equity assets in the U.S. actually overtook active ones. People voted with their wallets, essentially.
And the performance data keeps backing it up.
Pretty consistently, yeah. Those SPIVA reports from S&P, Morningstar data, they repeatedly show that the majority of active fund managers fail to beat their passive benchmarks, especially over longer periods like 10, 15, 20 years, after you account for their fees.
So the numbers are stark. What were they for 2024 again?
End of year 2024, SPIVA report for the U.S. showed 65% of large cap active funds underperformed the S&P 500 just in that 1 year.
And longer term.
Even more dramatic,
Really?
over 15 years ending December 2024. Across all the main U.S. stock and bond categories they track, not one single category had a majority of active managers outperform. 0. That's pretty powerful evidence for the core recommendation.
And his ideas seem relevant to things happening now, too, right? Like the AI stock frenzy, or looking back at the dot-com bubble.
Definitely. Someone steeped in Melchior, having seen the Nifty 50 boom and bust, would look at today's high-flying tech stocks and urge caution. Question the narratives. Question the valuations. Are prices detached from plausible future earnings? Remember the 70s PE compression. History rhymes.
And in panics, like 2008 or the COVID crash.
That's when the psychological armor is really tested. The pressure to just sell, get out is immense. Malkiel's advice, stay diversified, stick to your plan, don't react to short-term noise, becomes incredibly valuable. Crises happen. They don't mean the whole strategy is wrong.
Okay, so it holds up well in many ways. But no model's perfect. Where does it get challenged? Where does the critical perspective come in? Where does the model bend?
Well, a big area is behavioral finance. While Malkiel acknowledged biases, this field has really dug deep, finding patterns and anomalies linked to psychology that seem to contradict pure market efficiency.
Like what kind of anomalies?
Things like the momentum effect stocks that have done well recently tend to keep doing well for a bit, or the value premium, the long-term tendency for cheaper value stocks to outperform expensive growth stocks, and just the obvious existence of big bubbles and crashes. Prices clearly can get way out of line with fundamentals for long stretches.
So these anomalies, they challenge the random walk idea.
They challenge the strongest versions of EMH, yeah. And building on that research, you get things like factor investing or smart beta.
Right, trying to capture those premiums, value, momentum, size, quality systematically. Kind of like indexing, but tilted.
Exactly. It's an attempt to get a bit more sophisticated than just plain market cap weighting. It suggests maybe the simple index isn't always the absolute best, that you could potentially improve returns by tilting towards these historically rewarded factors. It makes the landscape more complex, though Malkiel's point about keeping costs low is still super relevant when looking at these factor funds.
And then there's always Buffett, Warren Buffett and the super investors. His 1984 talk pointing out multiple investors using Graham and Dodd's value approach who all crushed the market over decades independently.
Yeah, Schloss, Ruin. Buffett argued that concentration of success wasn't just luck. It's a powerful real-world counterexample to the idea that nobody can consistently outperform through skill.
So does that blow up Malkiel's whole theory?
Not necessarily for most people. Even Buffett says achieving that kind of result takes extraordinary skill, discipline, temperament, things that are incredibly rare. And interestingly, what does Buffett recommend for the average person?
A low-cost S&P 500 index fund.
Right. So Malkiel's advice is the population-level prescription. The super investors are the outliers, the exceptions that prove the rule is difficult to break.
Okay, so is active management completely pointless then? Even if most fail, some do succeed, especially in certain areas or time frames.
That's true. The aggregate stats are grim, especially for U.S. large caps. But yes, sometimes, especially in maybe less efficient markets like small caps or international or parts of the bond market, more active managers do outperform in certain periods.
Like that 2024 SPVA number for small caps you mentioned.
Yeah. 70% of active U.S. small-cap funds beat the benchmark that year. Similar things happened in some bond categories.
Right.
But the huge caveats remain. Picking those winners beforehand is the really hard part. And performance often doesn't persist. Look over 15-plus years, and the vast majority fail almost everywhere. The odds are stacked against you finding the consistent winners in advance.
And Malkiel himself softened his stance over time, didn't he? Acknowledging imperfections.
He did. Later editions acknowledge markets aren't perfectly efficient, behavioral stuff matters, but his core advice holds because he stresses the practical difficulty for you, the average investor, to actually exploit those inefficiencies profitably after costs and taxes. It's a pragmatic view.
There's also that theoretical limits to indexing idea. If everyone indexed, who sets the prices?
Right. Could it create more opportunities for the few remaining active players? It's an interesting thought experiment about market dynamics, but we're nowhere near that point in reality.
Okay, so we've looked at the core ideas, the critiques, the evidence. If you had to boil it all down, synthesize everything Malkiel taught us, what's the core distillation? What's the single most powerful mental tool you can take away from a random walk down Wall Street?
Well, putting it all together, you get this framework that's skeptical but also really empowering. It champions humility. It shifts your focus away from the frustrating, costly game of trying to outguess the market towards the things you actually control. Diversification, costs, your own behavior, your savings rate.
It changes the definition of smart investing, doesn't it? Not being the hero picker, but being disciplined, patient, participating intelligently in the market's broad growth. Managing yourself as much as your money.
Exactly. And the single most powerful mental tool to install from all that, I think it's this. Embrace your ignorance and trust the market's aggregate wisdom.
Embrace ignorance. That sounds wrong. We're supposed to get smarter, right?
I know, it's countercultural. We celebrate experts, gurus. But this is about a profound, data-driven acceptance. Accepting that it's incredibly unlikely that you, or even most pros, consistently have better information or skill than the collective knowledge of millions of market participants, all embedded in current prices. Trying to outsmart that collective wisdom, it's usually a losing game and an expensive one.
So the rational response isn't to try harder to be smarter than everyone.
The rational response is humility. Acknowledge the limits of your own predictive ability. Instead of searching frantically for the needle in the haystack, the one undervalued stock, the perfect market timing, just buy the whole haystack.
The broad, low-cost index fund.
Right. Trust the market's long-term trend, driven by the real economy, not your ability to predict the short-term zigs and zags.
Why is that idea, embrace ignorance, so powerful?
Because it's liberating. It frees you from the stress, the time drain, the costs of chasing market-beating returns.
It lets you focus on what you can control, like saving more, keeping fees low, staying disciplined.
And crucially, it puts the odds massively in your favor. You're aligning yourself with decades of research showing that this simple, passive approach beats most active efforts over time after costs.
And peace of mind, too.
Definitely. Having a sensible, evidence-based plan that doesn't depend on you being a genius, that lets you sleep at night, eat well, and sleep well, as they say.
It really is countercultural, though. The financial world loves heroes and hot tips.
It does. Malkiel gave us the intellectual framework to turn humility from a weakness into a strength, into wisdom. It breeds healthy skepticism, simplifies decisions, leads to better behavior, less tinkering. It's the foundation for actually building wealth steadily over time.
Burton Malkiel's A Random Walk Down Wall Street. It really was an intellectual earthquake. It forced investors to grapple with the limits of prediction, the power of the market's wisdom, and offered a path that was more rational, more disciplined, and ultimately probably more successful for most people than chasing quick riches. Thanks for joining us on this deep dive. And here's something for you to think about. If the market's collective wisdom is so powerful that even the experts struggle to consistently beat it, what does that reality imply for how you should consume financial news, where you seek advice, and maybe most importantly, how you define investment success for yourself?